In addition to active investment management, passive or index investing is an investment approach which appears to be increasing in popularity. Simon Midgen, product specialist at Legal & General Investment Management, presents his views on the index tracking market post-RDR and the selection process needed to ensure that advisors select the right funds for their clients. Simon joined Legal & General Investment Management in February 2012 and is responsible for index strategy, focusing on developing the institutional index management business. He joined Legal & General Investment Management from Market, where he was responsible for the commercial development of the iBoxx fixed income indicates. Before joining Market, Simon led the global licensing business at MSCI. His prior experience includes equality derivative product structuring and marketing at Morgan Stanley. Simon has an MBA from the Wharton Business School and an MA in Natural Science from the Gonville and Caius College, Cambridge. Following this video, advisors should be able to understand the drivers of growth in index funds in the UK retail market. Advisors should also understand the key benefits to using index funds, what to look for when selecting an index fund, and the benefits of adopting an index approach in emerging markets.
We think there's going to be a significant shift to using passive funds in the retail market, reflecting a trend that we've seen for many years by institutions, both in the UK and around the world, who increasingly have looked towards using index funds as the basis of forming their investment strategies. Disillusioned perhaps with the returns that they've got from active portfolio strategies and the significantly lower costs frequently for using index funds has driven a significant increase in the size of assets that is managed by institutions in index funds. Approximately 25, perhaps to 30% of institutional assets in the UK are invested in index funds, compared to currently around 8% in the retail market, and we would expect that that gap slowly increases over time. Particularly the recent changes due to RDR are expected to have a significant impact on the take-up by investors and advisors in using index funds. The focus on costs, which now becomes much more transparent to all participants, is likely to prove to be a major game changer and lead to the much wider adoption of index funds by institutional investors. So as the business models change by advisors, and advisors in turn need to demonstrate value to their clients, we can expect that low-cost funds which demonstrate good long-term performance are likely to play a much larger, a much more significant role in investors' and clients' portfolios. There are, I think, two key advantages to using index funds in client portfolios. One is to minimize risk, and the second is reducing costs. And I think many advisors and investors are familiar with the idea that costs are often significantly lower for index funds. And there's two sources of costs. There's the management fee that the manager of the fund charges, but there are also there are also costs within the fund itself that are perhaps hidden or not so obvious to investors, but ultimately the investors bear those costs in their investment returns. And those other costs include transaction costs and spreads that the trading activity that the manager of a fund undertakes within the fund has to pay to manage the portfolio. Typically, actively managed funds trade much more frequently than index funds, much higher degree of turnover, and as a result incur much higher costs within the portfolio. So they incur much higher transaction costs in addition to the generally higher management fees themselves. The other key advantage of using index funds is to minimize risk. Now, what do we mean by this? The role of an index fund is simply to track the performance of the entire market. So in a sense, the investor knows exactly what he's getting. The fund is expected to perform in line with the market, whereas an actively managed fund may or may not perform or generate returns in line with the market that the manager of that fund sets out to invest in. And experience over time shows that active fund managers generally are very unsuccessful in outperforming a specified market over the long term. And the graph on this page showing the performance of global equity managers against the underlying FTSE Global Equity Index shows that over both short-term and long-term, managers have, in aggregate, generally underperformed the market. So minimizing risk is very key, and there are a number of elements to minimizing risk that a passive index fund provides some attractive features. First of all, minimizing the manager-specific risk. It's true that some managers may generate attractive returns relative to the benchmark over a period. It may be a short period or possibly even a long period. But all the evidence suggests that it's very hard for a manager to maintain their performance over the long term. And it's even harder for an investor or an advisor to try and guess or to anticipate which of all the many hundreds or thousands of managers that are out there, which few managers will end up outperforming the market. So by choosing an index fund which is going to perform in line with the market, you're significantly reducing the risk of choosing the wrong manager and the wrong fund, and the strong likelihood based on empirical evidence that the actively managed funds will underperform. Second of all, there's other risks involved with country selection or sector selection. So a manager managing an actively managed portfolio will make investment decisions as to which sectors of the market or which countries in the sense of a global portfolio that he might choose to invest in. And markets are very volatile, and the likelihood of that manager successfully picking one market that happens to do well versus another market that may not do well is very, very difficult, and again is something that evidence suggests is not something that actively managed portfolio managers are frankly very good at doing. So again, a passive portfolio managed in line with an index tracking objective is likely to have the broadest range of exposure, the most diversification across the entire market, and capture all the elements of the market return, and in turn reduce the risk of picking the wrong sectors of the market, the wrong manager, and will do so at the lowest cost possible. Choosing an index fund provider is very important because it's very much the case that not all index funds are the same, and I think it's important that investors and advisors consider which funds they choose very carefully. We would point to 4 important factors that are helpful to consider when evaluating different fund providers. The first of those is scale. So in managing index funds, having large assets is very important. It's important because it allows the manager of the fund to achieve the lowest costs for his clients in running the portfolios. And costs, as we've mentioned, come out in a number of ways. Large scale allows the index fund manager to negotiate low commissions. It also allows to be able to minimize the transaction costs when the index fund manager needs to undertake transactions in the market within the portfolio in order to maintain the index fund's objective of tracking a particular market. So scale is very important. It's simply not possible to run an index fund with a small size of assets. It's important that there is a large base of underlying assets to minimize the overall costs for individual investors. Second area that I might highlight would be expertise. So there are many different ways in which index funds can be managed, and there's a great deal of knowledge that is involved in managing the funds, in understanding how indices work and understanding how different markets around the world work. And that expertise is not simply the result of running the fund in a computer and pressing a button and having the computer manage the portfolio. It's really required to have real people that have in-depth understanding of financial markets and the very minutiae detail of those markets in order to run the index funds most effectively and again to minimize costs as much as possible so that the investors get the most benefit from their money that's invested in the underlying markets. So managers that have a long track record, long experience of running index fund portfolios would be a very important consideration. Third point to raise would be simplicity. Index funds in concept is a very simple notion. The idea of the fund is just simply to track the benchmark. But how the funds are structured and how they're organized and the assets of the funds underneath is very important. And I think investors want a simple portfolio that invests predominantly in underlying shares and has a very straightforward approach. There are many different ways in which index funds can be structured, using derivatives, using other contracts with banks, such as swap contracts, that involve more complex features such as stock lending and other methods. And I think it's important to understand whether or not a particular index fund use a simple approach or uses other techniques that may introduce other degrees of risk that an investor should fully understand before they make their investments. And clearly a simple approach is easier to understand and it's more straightforward and serves the best notion of what an index fund, I think, is all about. And finally, of course, fees. So it's very easy just to look at the headline fees for a fund and compare different index funds on the basis of which is the cheapest. But I think it was very important when looking at fees to look at the overall value. The fees are not simply just the management fees, but also I think it's important now to look at the ongoing fund charges and indeed the total fees that an investor would bear when they're invested in their fund. And other fees can include maybe other hidden charges, fees for subscribing to the fund. There may be fees in the forms of explicit charges or spreads also when investors take their money out of the funds. So I think having a complete view of the fees and making a complete comparison between the total fees and expenses on different funds is very important, not just to compare the headline fees. And I think also as part of this idea of fees is also to consider the service that comes with the funds that are being offered. An investor doesn't simply want to just invest in a particular fund and never hear from the fund manager again. I think it's important that an investor would want to consider the level of service, the level of information and reporting and available expertise that is available from the manager of that fund to support the clients that are invested in that fund. So this whole idea of value, I think, encompasses both fees and service and support that's available from different managers. I'd also like to add it's important when looking at individual funds to look at specific characteristics of those funds, not just look at in addition to looking at the fund provider's overall range of products. The individual index that's used as the basis for the index funds is very important to understand, because indices really vary a great deal, both in terms of how they're constructed and how they're used to reflect the performance of the underlying market which they're measuring the performance of. And different funds use different indices. So I think it's important both to look at the underlying market and the countries or sectors of a particular market that the index seeks to represent. It may also be important to understand the effects of currency movements, for example, whether or not the movements in exchange rates for foreign markets will impact the return of the index and in turn the return of the fund. So there are quite a lot of details that can be researched around the index itself, and different funds use different indices, even when sometimes they appear to be based on the same underlying market. The methodology and the philosophy as well that the manager employs broadly may also vary between different funds. For certain markets, it may not be practical, for example, to buy equities directly or bonds in the case of a fixed income fund, and it may be that other methods need to be used. And again, this would be something that an investor would want to try and understand. There may be, for specific markets, the use of futures or swaps that may be necessary for the fund to gain exposure to that market, or it may be there are alternatives and one manager decides to use different techniques to track the index. Another technique that's frequently used, particularly for emerging markets, is the use of ADRs, American Depository Receipts. So these are shares which are listed in a foreign market which represent the performance of the underlying shares in a local market and are perhaps easier to invest in than buying shares in a local emerging market. But there may be differences between the shares that the index uses and the shares that the fund uses, and it may result in a movement or a tracking error difference between the two. And I think understanding those differences and understanding the source of any differences between the index return and the fund return is something that results from understanding how the manager goes about actually managing the portfolio in the particular index fund. So there are a number of techniques that index fund managers use to manage the index funds. And the first, obviously, is to simply fully replicate all the holdings of the index. So a manager in this situation would take each constituent stock of an equity index and hold in the funds each same stock in exactly the same proportions as the weights of each security or stock in the underlying index. And in theory, at least, this would enable the manager to fully replicate both the holdings and in turn the performance of the underlying index. But very quickly you can imagine actually this is not a particularly practical approach, not least perhaps for a large index, perhaps for a global market where there may be many thousands of securities in the index and frequently changes that need to happen as companies are added to or leave the particular index, perhaps due to IPOs or takeovers or other similar types of corporate action events. So full replication is not very practical. It's can be quite complicated and not least can be quite costly to replicate every minute little index change that occurs in the index. And of course, one of the main objectives in running index funds is to reduce costs as much as possible. So what are the other alternatives to fully replicating the index? One approach is what we would call sampling. So in this case, a manager would look at an index and perhaps break the index down by country or by sector, and within each country and sector take a sample of securities from that particular sector and thereby build up a portfolio which has broadly very similar characteristics to the overall index, but doesn't contain as many stocks and maybe contains most of the larger stocks, which would tend to be the more liquid securities and those, therefore, that are more easily investable. So sampling has the benefit of having fewer stocks. It's a bit more practical to manage, perhaps for smaller funds, but it suffers from the downside that some securities are missing from the portfolio that are in the index, and therefore there would be differences in returns between the index return and the underlying portfolio. And sampling can try and overcome many of these potential downsides, but inevitably there would be some differences between the sampled portfolio and the index portfolio. So another technique that is used is more of a black box approach. Using computers, we can use optimization techniques to construct a portfolio where the holdings of the portfolio are based on the returns of the index and the constituents of the index over previous periods of time. And we can construct a portfolio which is likely to have very similar risk and return profiles to the underlying index going forward. And it's likely that the portfolio in this case is going to be very similar to the index portfolio, but the optimizer may choose to select different stocks based on their risk-return characteristics compared to the broader index or compared to sectors and countries within the index, using this optimization technique rather than a more methodical sampling technique that was in the second example. So optimization techniques are frequently used. The trouble, of course, is that they're based on a computer, a black box, that uses data over perhaps previous periods of time to try and infer what the characteristics of the portfolio will look like and are expected to behave going forward. And sometimes that link between past characteristics of stocks and future characteristics clearly might break down, and therefore the optimization might not work as efficiently as it can be expected. Generally, an index fund manager might choose to use different techniques at different periods of time, because ultimately the best approach is a pragmatic approach. It's an approach that looks at the different and the best ways of replicating an index without using simple computer-based techniques, but with a deep understanding of the underlying markets to understand how to best track the index as closely as possible, but to do so with the lowest possible costs. And that's an approach that sits between fully replicating on the one hand and sampling or optimization on the other. but trying to find the best of both worlds. So to track the index as closely as possible, but at the same time always looking out for techniques and opportunities to be able to reduce costs and trade as little as possible to minimize turnover throughout the index. And when there are changes that occur in the index, perhaps due to corporate actions or to new companies that come to market being included in the index, to include those in the portfolio in the most efficient way possible, the most pragmatic way possible, and to do so at the lowest possible cost. So that's that pragmatic approach. The final approach, which is relatively recent, is what you might call synthetic approach. So in this example, the index fund manager would use derivative techniques using futures or swap contracts with a bank to gain exposure to the underlying index. And it may be that the holdings of the portfolio in this case are very different to the holdings of the index constituents. And these techniques are being used recently, particularly with exchange-traded funds and other types of index funds. And for many investors, these may introduce the need to look more deeply into how the funds are managed and the additional risks that may be involved in managing those funds to understand whether or not these products may be suitable. But certainly we've seen situations where a fund may hold a basket of equities, and that basket of equities may bear no relation to the constituents of the index. It's just through the use of a contract with a bank where the performance of that basket of equities that's held is exchanged for the index returns, and in so doing the fund gains its exposure to the index. So these are a range of techniques that are used, and I think, as I said, important to stress is actually it's not the case that one is better than the other, but frequently it's a pragmatic approach that's used in conjunction with a deep understanding of financial markets that is frequently the best, provides the best outcome for investors in one particular index fund over another. Why use index funds in emerging markets? Well, the arguments that apply to using index funds in other markets, developed equity markets, for example, apply equally to emerging markets. But let's backtrack a bit, because frequently the arguments put that emerging markets, i.e. investments in countries that are developing still, tend to be markets that are less efficient. There may be investment opportunities that research and a deep understanding of those markets can provide, and that many active fund managers claim to be able to identify as they research markets around the world. So why would that approach not work for indexing or apply to indexing? Well, just as the costs in investing in emerging markets are higher, both in terms of the effort needed to research the market, but also the cost to access the market, an index-based approach in emerging markets provides the same low-cost form of solution as it does for other markets. And we've seen that whilst there's a demand for many successful actively managed funds, some of the recently successful funds have had to actually close to new money, reducing their marketability and limiting the opportunity for investors that wish to gain exposure. So of course, investing in emerging markets through an index-based approach doesn't have the same kind of capacity constraints. Investing globally across many tens of markets through an index-based approach can be both low cost, but also because the investors money is being spread across many markets and perhaps many thousands of securities, there's unlikely to be any capacity constraints or any inability of index funds to be able to continue to grow, to absorb inflows of assets, of investors' assets who wish to gain exposure to these markets. And of course, as we've seen with developed markets, trying to identify which market or which country might be the next market to perform well is extremely difficult to identify in advance. Just as it's difficult to identify which managers may be successful in the future, it's very difficult to identify which markets are going to succeed in the future. And the chart that we can see on this slide just highlights the variability between countries that from year to year in the emerging markets world have performed well and have in subsequent years perhaps not maintained their leading position that they had in a prior year. And similarly, countries that had a poor performance one year would appear not to necessarily continue to perform poorly over subsequent years. So an index approach takes a very broad view and invests across the most diverse opportunity set, across the full range of markets. And as the markets evolve, as countries succeed within an emerging market index, so the return will increase of the index, and the structure of the portfolio will naturally reflect the higher weight towards the most successful and most strongly performing markets, and will have a smaller weight in those markets that have more negative return. So using an index-based approach for emerging markets can be very appealing. It's very low cost. There are no capacity constraints. And it's a very flexible way to invest, providing broad, diversified exposure without any particular bias to those countries that may possibly perform well or perform poorly based on prior performance. In considering different index funds that might be used to provide exposure to emerging markets, as with choosing a particular index fund in general, it's very important to look at both the index that's used and the method that the manager uses to manage the exposure to emerging markets. Gaining access to some of the emerging markets can be quite complicated and involve using indirect methods such as futures and American depository receipts to gain exposure to those markets, and they may or may not be the most efficient ways in which to gain exposure. So I think it's important to understand how an individual fund is managed and to understand the costs, the full costs of being invested in that fund compared to other funds that may be available in the marketplace.
We hope you now have a better understanding of the drivers of growth in index funds in the UK retail market and identifying the key benefits of using index funds. This has hopefully improved understanding of index fund due diligence and what to look for when selecting an index fund, as well as the benefits of adopting an index approach in emerging markets. We hope that you found this session useful. Thanks for watching.